Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menashe. If you're loving what you're hearing on the show, go out and tell two friends today about how easy it is to subscribe to the show. Spread the love around. Why keep all this goodness to yourself? On today's show, we're talking about another of the many distortions that seem to exist in our world. I've been to Greece many times. I love the food, I love the weather, I love the islands, and I love the rich ancient history. My father was born on the island of Rhodes, and he was born in a home inside the old walled city in Rhodes. Fortifications date back to the time of the Knights Hospitaller, and they were built in the early 1300s. My father's house dates back to the 1400s. Now, prior to 1910, the island was under Turkish occupation, and then from 1910 until the end of the Second World War, it was under Italian occupation before finally being returned to Greece after the war. I love going to Greece. But Greece is a chaotic place. The culture in Greece is one of rebellion. It's common for traffic violations to happen directly in front of police officers with zero consequence. Greece also struggles to have strong enforcement of tax collection. The underground economy is alive and well. Not surprisingly, Greece is also mired in debt. One sovereign debt crisis after another has befallen the country. The country has struggled to pay its bills. What's the solution? Each and every time, its creditors have loaned it more money, even though it was obvious they didn't have the political will to implement the austerity required to improve their balance sheet. But since the default was too distasteful for the creditors, it was easier to loan them more money and kick the can down the road. By the time the next crisis hits, hopefully, the decision makers at the bank will be retired and it's no longer their problem. Well, this week, Greece entered the negative club. What is the negative club, you ask? Greece sold a debt offering at less than 0% for the first time on Wednesday, in the latest sign of how far investors are willing to go and hunt for returns, amid a global slump in yields. The Greek government issued 487.5 million euros of three-month debt at a yield of minus 0.02%. The previous auction for treasuries back in August was at a rate of 0.095. The move reflects a broader shift in European bond markets in recent years, with investors paying countries like Germany, France, and even now Spain negative yield to hold on to their money. The negative interest rates are designed to hopefully bolster economic growth in the region. By the way, that hasn't worked. It also means investors are forced to take on more risk to generate returns, with Greece long being considered the final frontier of positive yield. The nation, which emerged in August of 2018 from an 8-year international bailout program, following a prolonged debt crisis, has been welcomed back into the bond market with strong demand for its debt. The falling borrowing costs in recent months are a sign that Greece is steadily being considered another Eurozone country in the eyes of some investors, after years when its survival in the common currency was rather in doubt. While the Greek government has so far issued only very short-term debt at negative yield, other European governments are borrowing long with debt that pays no interest. Germany, for example, just sold a 30-year debt at negative yield for the first time in August. The yield on government debt has tracked improvements in the Greek economy, suggesting that debt holders are not as worried they're going to lose money as they would be in the past. So the question is, would you be willing to lend money to the Greek government for 90 days and make the bet that they won't default in the next 90 days? More importantly, would you be willing to lend money to the Greek government at negative interest rates, even if it's only for 90 days. Perhaps purchasing a 90-day bond from the Bank of Canada at 1.75% might be a better bet. I know, you would face the costs associated with foreign exchange, and that would negate any earnings. So if you've got euros and you're stuck in euros and you want to place the money to work in euros, your choices are limited. Europe's a family, and within the family, there's all types of people. Even within my family, not all members are an equal credit risk. The very idea of lending money to my cousin who has a spending problem, because I don't know what else to do with my money, seems a little bit crazy. The idea of putting money in my cousin's bank account plus a little bit extra of interest in order for them to hold on to my money just seems idiotic in the extreme. Then again, we've just gone through a period of time when WeWork was worth $45 billion, and now people are waking up and recognizing that maybe it's not. Well, folks, crowdthink, groupthink, whatever you want to call it, can be a dangerous thing. Make sure to establish your own investment criteria and don't deviate from it. Doesn't matter what the rest of the marketplace is saying. As you think about that, have an awesome rest of your day. Go make some great things happen. We'll talk to you again tomorrow.